a Pan-African ESG and responsible investment advisory firm, and I have the pleasure of welcoming to the stage what I hope is going to be a very practical and informative debate on the challenges of operating in Africa, setting up offices, doing investments, generating, protecting, and enhancing shareholder returns. And we have a very distinguished panel who I will introduce from my left to right, from your right to left. So Martin Ofori, welcome to the stage, is Chief Executive Officer at Crystal Capital Investments Limited, based in Ghana, and previously Acting Managing Director at First Atlantic Bank, and was previously at the Bank of Ghana. An economist and banker with over 18 years experience, and most importantly, is also a partner for Africonomie in Ghana. And welcome to the stage, Martin. Next to him is George Odo, who comes to us from Nairobi, living and based in Nairobi, and is a senior partner with Africinvest, responsible for Eastern and Southern Africa. 20 years experience in private equity, working with institutional and other investors throughout all the stages of a fund. And he says, interacted with probably all the leading DFIs, European and US family houses and fund of funds. That's quite a thing to put in your CV. And he's currently trying to attract investors into his 200 million euro Pan-African fund, Africinvest Fund 3. And the reason why I mention that is very important, because I'll come back to it in just a minute. And then next to him is Garry Sharp, who has 28 years experience. We've got quite a veteran team here on the stage. Practitioner, consultant, advisor in private equity and venture capital markets. Provided training in the industry since 1990, been active in sub-Saharan Africa since 96. He's currently head of private equity at AfrAsia Bank. And he tells me he is heading up a team of one himself, which is really interesting, I think. Has been advisor to a number of managers in sub-Saharan Africa and written 7 books on the topics of private equity. I didn't know we had enough working material for 7 books. I see. 7 editions. It was bought out, the first 6, right? And then next to him is Mark Richards, joining us from Actis. I'm sure most of you know Actis, but for the sake of being consistent, I shall do the quick intro. A leading emerging markets private equity group. He joined them in 2006 and created the financial services team, which has led more than $1 billion of private equity investments since then. He's also director on the board of EMPH, Emerging Markets Payments Holdings, a business built by Actis to lead payment services and innovation in Africa, supporting the banking system. And as we know, only 10% of Africans actually hold a bank account. Adult Africans. Mark also sits on the board of Commercial International Bank, largest private sector bank in Egypt. Actis manages over $6 billion worth of assets. Prior to joining Actis, Mark spent 18 years at Barclays Group. So I really have a challenge as an MC here to keep all these bankers entertaining. But we welcome a challenge. And then here, relevant experience is Alexander Forbes, the recent exit that we went through. So I think we'd be welcome to reference to that, and it was the largest buyout done by private equity on the continent. Now, in preparing for this, we met previously in one of the many rooms in this glorious hotel. And it was very interesting, because if we look at the panel across here, we have a full spectrum of representatives, and particularly with regards to where their money comes from. So starting with Mark, who started off in 2006 and 7 with 100% DFI funding. They have now over 150 institutional investors in their funds with only a 10% DFI component. Garry, on the other hand, is working entirely off balance sheet, has yet to do a deal through AfrAsia Bank, and is obviously getting started. Whereas George is onto his third fund and is roughly 60% DFI funded, if I'm not mistaken. So an interesting spectrum. We have some key themes we would like to talk about. But before I do that, I'm going to hand over to the panel to talk about the key topic, the challenges of entering emerging markets. I think one of the things that we've spoken about is how different Africa is. It's not one country. It's becoming increasingly heterogeneous in its markets, and how different funds and their managers have structured themselves to deal with these different challenges. So gentlemen, if you don't mind, a couple of minutes sharing your top of mind thoughts, and then we'll get into some of our key themes. Thank you.
So who's starting? Mark, over to you. From the Actis point of view, I think we were just listening to a macroeconomic view of Africa. I will turn the conversation to say it's all about people. Our experience of making investments is find good people, get good people around you, support them. Then in most macroeconomic environments, good people with a good business model will make money. And I think that's the essence of what the Actis investment thesis is all about. Now, we do it through a matrix these days. We have people on the ground in market who understand the environment. I think all of us would agree that understanding what's going on locally is vital in Africa. It is very diverse. But we increasingly do it with a sector-based model in addition to that. So in your introduction, you mentioned a company called EMPH. Just to give that example, this is a thesis-driven investment strategy. It was taking a view of the African banking industry, the payments markets, and saying there is no first data in Africa operating. There is a space for something like that. And if anybody could build a business across the continent bit by bit, you would build something very exciting. So that's an example of why Actis has specialist teams within industry segments. So off we went, and we bought a business in Egypt, we bought a business in Jordan, we bought a business in South Africa, we greenfielded it in Nigeria, we greenfielded it in Kenya, and we built a business that operates in 40 African countries. Now that is an example of sort of pulling local and sectorial perspective together, and that's how Actis really operates these days.
Thank you. How long did that all take?
We've done that in 3.5 years.
From 2000 and...
From 2010, or halfway through 2010, and we're still going with that. Today it's a $35 million EBITDA business.
Garry.
Thank you, James. Different perspective. I would argue that I've always worked in emerging markets private equity, because when we started our group in the UK in 1985, private equity in the UK was an emerging market. And we made an awful lot of mistakes. People look at private equity as if it is some unstoppable money-making machine. People look at the returns. The fact is it's not. It's what many call a talent-driven business. It is a range of extremes. Something like half of all private equity funds lose money for their investors. The reason the asset class works as a whole, because a small minority make huge returns, which drags up the overall average. So you've got a massive range of performance within an asset class. And we're seeing this emerge in many of the... My first deal was back in '96 in Uganda. We're seeing the same thing emerge here, the big diversity between the small number of very talented GPs and the larger range of people who are getting into the market, often raising money for one fund and one fund only. And that kind of leads to a key thing from my experience, which is the dangers of extrapolation. We've seen the big Pan-African funds, the successful ones, such as Actis, ECP, Helios, and so on. But we're also seeing private equity building from the ground up, and it's a ground-up aspect of private equity that interests me particularly. Looking at this from giving input to LPs who are allocating funds to growing GPs, my key points really are: be careful about extrapolation and make sure that the GPs you're looking at do have the resources, not to make their last fund successful, but do have the resources to make the fund they're currently raising successful. Because I think in many cases that will be a completely different proposition. I mean that with all due respect to George, but I think that's my overall introductory take on it.
Couldn't agree with you more. Currently in Nairobi, we have an estimated 35 first-time fund managers trying to raise money on top of an existing 25 members of the East African Venture Capital Association. So, crowded market indeed. But you mentioned the small number of very talented GPs. So that was a perfect introduction into George. So those making stellar profits.
Thanks a lot,
show us how it's done.
Yeah. So just a point of correction. I myself do not have 20 years experience in private equity. Our group has 20 years of experience in private equity. I have about 6-7 years because I was doing something else, but I have 20 years plus working experience. So just a point of correction. And I think you're absolutely right, Mark. One of the things that's most underrated and extremely important are the people. We've talked about a number of things. We heard a lot of things about the macro items, issues. I think what's missing there is the emphasis on the right team, the right people, and both yourself and Garry have hinted towards that. I think that's extremely important for any institutional investor that wants to go into the market. You have to understand the environment, also make sure you identify the right team. However, I think one of the things that people tend to get wrong is, you sit back and you do a lot of desktop review. What's going on in Africa. You become an Africa expert having never stepped into Africa. We have a lot of that happening. And a lot of institutional investors tend to rely on this sort of data and information to make decisions. It's very important to understand what's going on the ground, have boots on the ground, have people there. You cannot, I think the old model of fly in, do a transaction, briefcase and fly out, that's never going to succeed going forward. You have to have boots on the ground, you have to have people understand the environment. It's extremely important. So it goes back to understanding the environment, having the right people on the ground. And that's a worry a lot of LPs have, limited partners, a lot of investors have. Solution is find people who know the business, know the environment if you don't yourself. If you're a new first-time investor, find people who know the business. I'm not in any way going to try to make a pitch for my fund, but we've been around for 20 years.
Please don't hold back.
We've been around for 20 years, almost $1 billion of assets under management today, and our specialty is the SME space. Yes, in the early days, we did more than $1 million, $2 million investment. Now we're more on the $20, $25 million per ticket. And one of the things that we've realized is you keep people, if you have a strong retention rate, people who understand the environment, you have people on the ground, then that counts for something. And if you're a new investor, one of the things institutional investors worry about is how can they get good people? How can they get people who understand the environment? That's an important puzzle to crack. The challenge, of course, always comes when you're dealing with, we're at a phase where we have a lot of institutional investors who are DFIs. And they have their own nuances, they have their own demands. A little bit different from the real private investors. So very often we find in the early days we nodded a lot more and listened to them a lot more. Today we nod a lot less, but we still listen to them. So they have a lot of demands, rigorous demands around ESG. And things like that, which the private investors have less and less. But we have to find a way to manage that. Until we get to a point where we are less dependent on DFI funding, it's something we just have to deal with.
You remind me of a recent series of meetings I had where the difference in approach, and ties in nicely with your briefcase model. So one DFI, who shall remain nameless, really encouraged me to open an office in London. It was good, they said, to have someone just down the road, someone they know, someone they can pop in to see from time to time. The other DFI, a European DFI, said the last thing we want you to do is to waste time and energy setting up an office in Europe. Please make sure all your offices are in the markets that we wish to serve, namely Africa. So I thought it was interesting that So thank you very much for that. And then I think also just to stress, as far as I'm aware, private equity is the only formal institutional investment market that is in taking a view on the SME sector in Africa. And it's the SME sector where we're going to get the high number of jobs, growth, where we're going to get the skills development, where we're going to get the sewing machines in a warehouse, which is what we really need. Martin, over to you.
Yeah, and just to, just continue from where he ended, people think that you need to identify a GP that is growing, a GP that has the resources to be able to attract more and stuff like that. And so the idea has been that people sitting here will just look at GPs that are progressing, have maybe a bigger balance sheet and stuff, and want to align with them. And so you see that almost everybody is dialing into the same institutions, and then they continue to grow, and it gets to a point where there's inefficiency, because this normally happens with a growing institution. Now, what I want to say is that it is not long experience. Long experience is not always the best teacher, but fresh experience is. That is my quotation. Fresh experience is always the best teacher.
I think it's more about knowledge of the market.
Absolutely.
You don't have to.
So the key thing is understanding of investors of the market, the African market. Yeah. There is always I think there's always that kind of problem where people don't really understand what is going on the ground. They have a certain perception about African markets, and they just want to deal with everybody in the same way. We need to understand the market. Sometimes we hear something from the macro economy, and then we align everything to what we hear, either on the internet or from desktop researches that he just talked about. But if we could identify the right people on the ground and have dialogue, we could identify products that sell and align the kind of investment we want to make to our objective, we will be able to go far. What is happening is that if you look at African markets like Ghana, every investor is looking at liquidity. Everybody, because the market in Ghana at the moment, as it happens, as it is in most West African countries, is that things tend to revolve around the political economy. Okay, so everybody wants, before they even invest, they want to find out the exit strategy. I mean, how long am I going to stay in? Am I going to revolve? Am I going to go through two political tenors? So they just want to go in. If this government is good, we want to go in and make sure we exit before the next government comes in. All these things have not helped. What I think we need to understand is the right type of sectors, the right type of investment that is really making inroads, where we need to actually put our eyes to. Okay, so the long-term versus short-term approach, the institutional structure and governance approach is very critical, and then we need to, and we also need to look at how emerging institutions can make a difference.
Can I jump in there, Martin? I want to ask you a question. Let's get the panel discussion going. So what you're talking about is patient capital, taking a view that spans generations of government. We saw the earlier side, Razia had as a closing slide, the number of years that political parties have been in power in Africa. And we saw that, I was surprised to see that even Mugabe isn't number one. He's running a paltry number 3. I'm sure he's set his sights on being number 1. But yeah, there's some frightening numbers there. So yeah, if one's hedging one's bets on trying to exit before government changes, it requires patient capital, which also speaks to understanding the markets, which means speaks to investing in people and building skills sustainably. So pension funds, sovereign funds, they're long-term players, long-term providers of capital. So why do we, as private equity, and I'm speaking here as a table as private equity, feel that we can align ourselves with those expectations when, you know, you already established your, you know, exit strategy before you even sign a term sheet? Mark.
I think a lot of the opportunity in Africa is about building businesses. And the shortage is, from an investor's point of view, is great businesses to invest in. There are some, and there are lots being built. But it's the building bit that's the scarcest skill and the scarcest commodity of it all. Now, long-term patient capital is very good at investing in providing expansion capital to that institutionalized business that has got good governance and good management fully embedded in it in a product set. It is not very good at building businesses. And a lot of private equity in Africa is about building things. And it's about taking businesses that have huge potential and a great bunch of people and providing the missing elements to the question. So a lot of our style is to look at an opportunity and say, well, what could be in 5, 10, even 20 years? And we're certainly taking that sort of view in the businesses we're building. But we're about organising resources, management team, tightening down the strategy, joining up the world, bringing best practice ideas from multiple markets to an opportunity. Now, those are the businesses that institutional investors want to invest in. I once asked an institutional investor, well, what do you like investing in Africa? And he said, where Actis has been. And what he meant was he knew that we would have put in very tight governance controls into the business. He knew that the business would have a very tightly defined strategy. He knew that there would be a management team with a succession plan, and he knew that there would be a deep talent base in it. Now, that's what I think most institutions want to invest in. That's what we do, and that's why private equity is so important to Africa.
So how do we, I mean, I know governance, and Garry, I'll come to you now. So how do we institute appropriate governance structures without killing the entrepreneurship that got us interested in the deal in the first place?
I do remember hearing about 6 months ago an American pension fund executive saying, we have our governance model, it works, and we're bringing it to Africa, and it will work there. So I thought, well, good luck with that. I don't want to be around. I think the answer to your question comes back from something excellent that Martin said that got me very interested, is you have to understand the local environment. You have to understand how people work in practice on the ground. Our business is, people talk about big statistics and that sort of, our business really is a ground-up business. And if you're going to build a governance model, it has to start from the reality of how people do business in whichever culture you're operating in, and build from that into something that the broader institutional world can understand. And I think the issue we have in a lot of sub-Saharan African private equity today is what we might call polarization or even binarization. There are 4 or 5 GPs, Actis, Pelios, now Carlyle, etc., who meet the requirements of, let's say, your classic American pension fund. Those GPs raise lots of money. Everybody else finds it very, very difficult because the Western investors do have these preset requirements. What we need to do going forward is finding some way of bridging that gap between a lot of the value-adding GPs on the ground in Africa and the big money with the big rules from the West. I think one of our issues is there's a big gap there, and we need to talk about ways about bridging that gap.
I'd like to pick up on that theme because it speaks to people, systems, structures. So, George, I mean, what are your LPs looking for as you try and transition your fund management strategy from being DFI funded, right, as the catalyst, as the seed funders, seed investors, to a more commercially based Fund 8, Fund 9, right, when we get there? What are you looking at your team and saying, well, this is what LPs in the future are going to be looking for. This is what the pension funds in the room want to see in your team before they invest?
A very, very good question. What we are finding, and we are finding that we can demonstrate that more and more today than we were, 10 years ago, 15 years ago, is, and I'd intimated to it earlier, is a team that sticks together. So people, they don't see people walking.
Continuity.
Exactly, that's important, stickability as we used to call it in our old days. So they want to see people are sticking around. That's key. You've got key members who have been around, can demonstrate some experience. That's very important. There's also the importance of understanding your business, sectoral expertise. So there has to be some specialization of some sort because, yes, it's possible. We run generalist funds, but there's certain sectors we know well now. We know the education sector well. We know the health sector well. We know the financial sector well. We've done this for 2 decades. So it's something we've learned from that. So some sort of specialization is key. And then if you talk to a lot of people who know our group, they'll tell you that these guys are good. They'll not lose your money. They're safe pair of hands. We're moving away from that, if you like, stereotype to a little bit more adventurous, taking a little bit more risk, but giving the returns. So still safe pair of hands, but with higher returns. In the early days, if you look at our earlier funds, we could demonstrate 2 times money back to our investors. Today, we're very clear that in our new fund, it's 3 times money. We're very, very clear about that, and we've been able to demonstrate it from our last few investments. And so the way our raison d'etre has changed, the way we do our business has changed, but we're learning from what we've learned, what we've done well before, sectoral experience, some regional experience, some countries. So some sort of clubbing. We've recognized that there is a lot of, intra-country, and not just on a cross-border, as was stated in the first panel, but also around the same region, a lot of trade taking place. And we're finding that is appreciated by investors when they look on to see that you've learned that and you're carrying that along in your investment thesis.
Martin, okay, so this is the last question in down the row, and then we'll just open it up for any central themes. But I would like to bring in your experience as a banker and being involved in the banking environment in Ghana. And Ghana is going through obviously interesting phase at the moment. But in terms of increasing the allocation of pension fund money to local asset managers, the role that regulations play, in your mind, is it a push or a pull? Do we as the private equity sector actively engage with pension funds to try and change those policies, or engage with the regulator, or do we sell our own story through our track record and our people?
Yeah, I think we have a very peculiar thing, especially in Ghana, where the pension funds, the pension reforms are very new. They are very fresh. We've just had very fresh regulations. And so the whole thing has been skewed towards investing in government assets, what is called the risk-free assets. So about 75% of the second-tier pension funds are all expected to be invested, in government funds. And the private equity firms want to attract some of these funds, and it has to be. It's got to be that there's got. We have to lobby because we don't have a very formal kind of platform to negotiate this kind of thing. So it's just been in the form of lobbying here and there. The last time that Africonomie held this conference in June, it was a major thing where we brought all the stakeholders of the pension kind of sector together under one roof. We had the regulators and the players, the asset managers and the pension fund managers, together to lobby. But I would say that beyond that, the institutional framework of the financial sector has, to a large extent, impacted on the way or the role of equity fund managers, in a way. So what has happened is that the banking sector is the dominant, sector within the financial system. And in Ghana, almost all attention has been, focused on that one, leaving the very large non-bank financial system, kind of unattended to, in a way. And so almost all the people, the equity funds that are even trying to invest, even in the banking system, have issues. I remember when I was leading the capitalization team in the First Atlantic Bank to recapitalize the bank, in line with the then regulation, We had a lot of engagement with people. We had Africinvest, we engaged Africinvest, ECP, and so many other financial institutions. And all of them came, and if you look at the objective, they wanted to exit within 2 years. You understand? And this is investment into the financial system, which is already formal, and everybody understands the way it plays. So if you look at such things, how much would you consider getting some of this investment into the other sector, the real sector, where definition of performance is even difficult? Understand? So that is why I'm saying that understanding of the market is key. It is clear that all these investors did not really understand the long-term nature of growth within this economy. And so we need to understand this, align our objectives clearly, so that we'll be able to have a rolling kind of short-term to long-term kind of investment objective, for a successful investment.
Thank you. So in preparation for this panel, which is the proven practical steps, stressing the word proven, for institutional investors entering African markets, I asked the panel to discuss what some of their key lessons or challenges have been in terms of entering the African markets. Top of the list was a shortage of quality deal flow, size, suitable sectors, geographies, etc. Mark, would you like to elaborate on some of your experiences in that regard?
Yeah, all investors in an ideal world want a perfect management team with a perfect profit base, with cash flows going off into the future. And if we all charge around Africa looking for those, there aren't that many of them. Now, that's always the dilemma. The private equity industry in particular, in its European and US forms, is traditionally a buyout industry, and that's what that side of private equity does. It buys leveraged cash flows and uses debt. Now, African private equity is very different to that. It has to be growth capital because that maturity isn't there, and it has to be about building businesses. So the first adaptation that anybody who's new to the continent or a new investor would have to make is that distinction, that you are going to be rolling your sleeves up and building operational businesses, not doing financial engineering on cash flows.
But yet we see that GPs comprise exclusively CAs or financially orientated people.
I'm not sure that's right. I mean, we've brought in a lot more people from industry with operational management experience precisely for those reasons. And I think that's a trend that, I see my fellow panelists nodding here, I think that's a trend that's happening tremendously. I think the idea that somebody who's got an MBA and a financial degree is actually going to be a good investor in Africa is absolutely wrong. They might understand the numbers, but you've got to actually understand how to build a business and work with people and real life.
How many engineers in the room? 3. And a woman engineer. Fantastic.
I agree with what Mark's saying, and it comes back to some points George made that I really wanted to talk about, especially from the institutional, from the LP perspective. George said 2 very interesting things. The first is that they are becoming increasingly specialised. And this always happens but it's not just Africa, it happens in Europe as well. As the GPs get more experience, as markets become more competitive, we have to become more and more specialist, to the point where in very mature markets you have single industry, single sector funds. Related to that, we see more and more operational experience. Again, it happened in Europe, and now it's happening in Africa. So that is a trend to look for. And I think pension funds, looking at which GPs back, would benefit from understanding that is a trend to be looking for. The second point, and this is more controversial, is your point about increasing returns from 2 times to 3 times. I was working with the DFI last year, who shall remain nameless, but I was helping them with their GP selection process. And they've got quite a lot. So I ended up looking at a lot of African GPs because they have quite a big portfolio. And I said, if something starts going wrong, do you rush resources down there to stop it going wrong and make it better? And they sort of came back with, yes, we do. And I said, well, you're probably wasting your time. What you should be doing is finding those which are performing strongly and devoting more resource to making sure they perform even better and you get your full upside out of it. Because the way private equity works is a portfolio business. The way to minimize risk is actually to maximize returns. There will be losses. You can't avoid them. The way you make this work is making it work across a portfolio, which means capturing all of the upside, which is why I thought that comment of yours was particularly interesting. So.
Yeah, I mean, totally agree with what the other panelists are saying. Just to latch on to the last point, how we've managed to deal with the issue of, what seemingly contracting deal flow, window is we try not to chase the same deals everybody's chasing, because it just ends up being, who's got the fattest wallet and probably not the smartest fellow who'll pay for that. So we try to, and I know all GPs say this, we try to find proprietary deals. Sometimes we do compete, a lot of times we do complete. Right now in Kenya, in East Africa, GPs are tripping all over each other looking for transactions. The way to do it is, one, being able to demonstrate that you are going to bring real value addition from past experience, but then also just trying to find, you're going to grow a business, you're going to create new businesses. Sometimes you do it with an experienced old hand. So you may not necessarily refer to it as a greenfield, but it is a greenfield. So you go with somebody who's been in the banking industry for eons and go with them, create a new bank in a new market. That is a greenfield.
But isn't this just speaking to the fact that these are just, the growing pains, the developmental stages that we need to go through? So portfolio companies also need to come to the party, and instead of just asking, well, how much money you're going to give, also asking the question, well, what else are you going to bring? Relationship capital.
It's inevitable. It's inevitable.
That's the core issue, because private equity people will all tell you they want 3 times money, 25% internal rate of return, and any of you in the audience will say, well, that's a ridiculously high cost of capital, and it is. So I think the way that we rationalise it is we've got to be worth 15% of that IRR in terms of added value. Yeah. And that's the test, I think, that you've got to employ, and it's what I would say to a partner company or indeed an investor in us. Do you believe we actually are going to, because of our efforts or our additive factors, create that extra bit of value? Now, it can come in many forms, and we'll all have our own versions of it. But that, I think, is how the whole industry grows, and it's becoming more and more specialist. I mean, we've gone down into specialist healthcare teams, specialist education teams, specialist financial services teams, and we actually only do 4 themes of financial services these days. And we, as a matter of principle, every African company we would look at in financial services, we'll have benchmarked its equivalents against our Chinese operations, our Indian operations, our Brazilian operations. And we will link the CEO of that company with their peers within that network, as well as bringing a European and a US perspective, only if the collective consensus is there's potential, will we invest in it? Yeah. But our pitch to those guys is, we will join you up to the world. We will show you your company, your industry at different stages of development all over the world. We will bring you a chief executive from the other side of the planet who's run a business 10 times the size of yours. He will mentor you. That is some of the added value. And we've all got to have our own versions of that.
And you will walk away from some deals.
Absolutely.
Because they just don't make business sense. Business sense from your target perspective, business sense because the chemistry is not there, business sense because you may not be able to add value. You will say, you know what, this is not for me, and you let it pass. And so you can get that 3 times money by getting in at the right price, by exiting in the right manner, by doing all the other value creation, link-ups to similar businesses, introducing them to other businesses, strengthening the governance. There are many ways to do it, but again, sometimes it just won't be for you. That's just the reality.
But if the chemistry is right, it's a very
you
powerful
can build
combination.
It, absolutely.
But that's a luxury if you have a global resource of CEOs distributed in successful territories who can help others. I mean, what's your advice to, the successful first-time manager who's now looking to raise his second fund at 4 times the money that he had before, but now is experimenting with new geographies, new territories. From the GP, so let's just keep this from the LP point of view, that could be seen as diversification of risk. But then there's another element of risk in that now you're playing in sandpits that you don't know. So what's the right balance from an LP point of view? And guys, please sell yourselves here. We got people with checks in the room. So
my argument to LPs in that has always been, if you think you are diversifying risk by backing a GP that's going, and George might hate me for this, but I'm sure you're an exception, that is going from a track record in one environment and then broadening their investment mandate. If you think you're reducing risk by doing that, I think you're probably not. You're probably enhancing it, increasing it. If you want to go the diversification route to reduce risk, I would start by looking at 7 or 8 local GPs across 7 or 8, instead of putting all the money in the hands of one GP that claims to be Pan-African, and both Mark and George are going to shoot me afterwards. Instead of doing that, I would go Pan-African by finding 7 or 8 local GPs and backing them separately as an overall philosophy and approach.
The disadvantage of that approach is you will not benefit from what Mark said, where you can pick up the phone and call the pharmacy in Ghana and say, you know what, I'm sending the guys from Uganda over to you. Or pick up the pharmacy, put the guys in Ghana on a plane and send them over to Tunisia. That network, you're not able to leverage from that. So that's the disadvantage. Then the other disadvantage is GPs are naturally, we were remunerated based on performance of our funds. Now, if you have one fund, one country, one sector, whatever it is, it tanks. That's it. But if you have your eggs spread over, from a GP perspective, what you want as an LP is to align yourself with a GP. If we have our investments spread over a real diversified portfolio, not a country-specific risk, you're probably going to have your GP sleeping better, your LP sleeping better. So from a risk perspective, it's not quite the same. I have a different perspective, but yes, I hear what you're saying.
Yeah, my comments were aimed at LPs. I can see why, as a GC, you would want to go
absolutely.
that way.
And the other thing that's also key,
be careful about.
I think the other thing that's also key is that even when you find GPs who are claiming to be Pan-African, you cannot be in every African country in the whole continent. You've got to have a specialization. You've either got to know this region well or that region well. So.
But you see, Garry's point actually brings us to this puzzle. I mean, how can you identify other potential performers like the one that you have seen? Because it's possible that the one that everybody is dialing into may have certain kind of deficiencies along the line. You understand? But Garry's point actually opens the door to what I consider to be a puzzle. There are new and upcoming ones who may have the product and project structuring abilities even better than the one that is already known. I mean, how would you identify such ones and pick them up? And that is a crucial thing. How can you also align the private equity objective to a situation where national assets like pension funds can also provide a matching fund, for instance?
I think this is a very key point because for those of you running pension funds in the audience, you've got an asset allocation problem. It strikes me in Africa.
Sure.
We were talking last night to a number of the national pension funds, and you've got a very limited set of choices at the moment. They tend to invest in government bonds and one or two other things. And we were comparing and contrasting the evolution in Latin America, which has allowed a diversification of pension fund assets into new sectors and new themes. Now, the national pension funds are the ones who should be investing into the new asset classes in Ghana. But at the same time, they do want to diversify their risk because the country correlation risk is very high for all the reasons the macroeconomists were saying. So I think my message would be there's room for both of us in different forms. as a pension fund, you need a family of assets of different types of risk return, of different risk correlations to each other. We provide you the diversification risk, you provide the local knowledge. And don't put your eggs in one basket. Gary's absolutely right. You want both of us. We will both deliver you returns, but in a different way.
And if you would allow me, I'll just tell you what we are trying to do in Ghana, for instance. There is this kind of misalignment of objective. Government thinks that, all pension funds should be invested in the government assets, and there are private equities who are known, and therefore the private equity firms that are known, the asset managers who are known, are the key ones that everybody knows. And there are young ones who have, some of us have been on both sides. Have been on the banking side. We've looked at a situation where we were trying to attract private equity funds, you understand, to invest in the banks. And then I'm now on the other side, you understand. And some of us have sat down and analyzed the market, and we think that the only way is to be able to come up with a bridge, okay? Structured products that will align with the banker's deal or desire, as well as the private equity desire. So you come in the middle. Right now, in order to do this, we have lobbied government to be able to, and regulators to be able to invest some of the pension funds into products that we have developed. Okay? It is going through the approval process. At the same time, such products can easily sell to very smart private equity firms. You understand? And we think that a private equity firm that is prepared to come in and exit in a short time can do so. Because the moment you do that, you can exit within 1 year, you can exit in a maximum of 3 years. And when you do that, you build capacity, you introduce liquidity, and then the risks that we are all trying to mitigate will be seen that it has been really mitigated.
So when I was saying sell yourselves, you took the real spirit. Took it. Any questions, please? Anybody? Here we go. Where's our roaming microphone? Our roaming mic is propping up the T-bar. Here comes the mic. All right, thank you. Please introduce yourselves.
Thank you. Vivina Berla, Saron Asset Management. I actually have I wanted to pick up a point of Garry's, who mentioned that he advised the DFIs to seek 3 times return not by sending people to help, but when they have a problem, but to make sure that they find the right people and then ensure that they get on with it in the right way. And I suppose my point here, and that's where the question comes into all of you, do you look at different investors according to their different motivations? Because I would argue that for Africa, different investors will have to come in with different commitments to doing the right thing in the right way. And I think that advising a DFI to just seek higher returns without helping is misguided. Sorry.
A broader point about the realities of how private equity portfolios work. I fully accept that DFIs have other obligations, other commitments, and other priorities as well. I think the point I was trying to make, which most people would recognize, is that when we look at returns from a private equity portfolio, that is how they are distributed. You get a small number of high performers, and on a purely financial return basis, my advice would be, Rothschild said, nobody ever went bust by taking a profit. And in quoted markets with the normal distributions of returns, that would be correct. In our market, it's not. Because of the way returns are distributed, you have to take out the maximum amount of profit you can from every successful investment. So although I take your point about financial priorities not being the only DFI priority, if we're looking at returns, I think I stand by what I said.
Yeah, just building on Gary's point, I think the lessons on private equity returns at portfolio level are the most successful funds are those that avoid losses. So if you have a portfolio of 10, you cannot afford a couple of them to go bust. Or if they're going to, move on fast and double up your winners. And I think that's really the point that Garry is making. Now, that's Darwinian behaviour, and I think it's frankly the story of the growth story of Africa, or indeed any market, that some companies will succeed, some will fail, but the lesson is make your judgments quickly. I think Actis's journey with dealing with investors with different perspectives is quite significant, because we started with one, we now have 150 institutional investors, and they come from China, they come from Latin America, they come from all over Europe and the US. We have had to self-select that investor group, that they are like-minded. The sheer geography of and religious motivations of some investors. Some people don't like investing in gambling or alcohol. We don't do that to reflect our investor appetites and probably our own values. So you do get clustering of behaviour sets in investors, and we do send a very active sign-up, the poll that says if you invest in Actis, you get a particular type of investment. Our brand says we do things properly, we do things ethically, and we will walk away from transactions if we get into ethical dilemmas. And that does self-select our investor group. We've turned people down as well as invited them into the tent. And I think all of you, in making your own choices as investors, will cluster together with like-minded souls, because we need to work with investors. We have investor panels, and there are difficult decisions from time to time, which the GP will involve the LPs in. Do you want us to keep going on beyond the life of this fund because this investment is great, or do you want us to not to go into that country because of this or that political risk? And we do talk to our investors about those things. So we're looking for a community of shared values in our investors, as well as we are in our portfolio companies. And I think that self-sustains, and gradually, over time, everyone gets their own brand developed.
Any other questions?
My name is Efe from Stanbic IBC Asset Management. During the conversation, I heard, I think, George say that it could be possible for you to ignore some investments where you would add little or no value, even though the exit multiple is great. So I would like to ask that, has it happened before? And is it true that you would do that? And if you have, so to extend the discussion, if you have two investment opportunities, one where you would add great value, but the multiples will be reduced, and one where you would not necessarily add any value with low multiples, which would you select, and how would you convince your LPs that you selected one or the other?
George, I guess that's for you.
Yes, we have walked away from deals before. You're right, and it's been for various reasons. Sometimes we're not comfortable with the political risk. The people around the investment maybe have certain political inclinations. We were not comfortable. We walked away. Others did it. We didn't do it. That's been one reason. Another reason we've walked away is our business. We believe where we add values on growth capital, growth businesses. So if somebody comes to us with a proposition, it's a pre-IPO, make a quick buck, buy in low and go make money in a couple of years. Again, that's not what we were set up to do. That's not what LPs give us money to do. And we actually meant to grow African businesses. So we would walk away from an opportunity and have done so in the past. Sometimes, again, when you're doing your due diligence, all the numbers make sense and everything. But when you just go in there and you look the people in the eye and you say, no, there's something that doesn't add up here. If the gut feeling isn't right, the instinct isn't right, because you're going to work with these people for 5, 6, 7 years, because we invest between 5 to 7 years. If the feeling isn't right, it's not a debt transaction. Debt transaction, you can lend to anybody, even the devil. But equity, it's a little bit difficult. You cannot
Not
work
recommended.
with this person, so we would walk away. So we have done that in the past, when various reasons, but we've done it. So money is not always the only motivation. We want to see that we can help the investee company get to the next level.
You're sitting under a banker's sign there, so. Last question before we move on. It's time for one more. Nope. Going. Thank you very much to our panel. Please, if you could express your thanks to them.